In this chapter, we're going to be going over Chapter 17, Understanding Accounting, and some of the financial information. Things we'll get into: what is the accounting information and the cycle, looking at some of the financial statements, analyzing our performance, and then thinking about the different disciplines that go along with accounting. Now, first of all, what is accounting? It's the language of business. What you're doing is you're recording, classifying, and summarizing all of the financial stuff that's going on within the organization. It's used primarily by employees, management, creditors, all of the people around the organization that may need some information as far as what's going on in that organization. The system consists of the inputs, the processing, and the outputs. Inputs are all the documents and the records that we're doing where we're spending and getting money. Processing is actually putting all of that into the financial statements, so your outputs are your financial statements so that people can make decisions as far as what's happening with the business. When you think about the accountant's responsibility, the primary part of it is tax reporting and figuring out what the taxes are, and auditing, making sure that everything was done correctly. The people who are using the accounting information, first of all, the government with your tax returns, various agencies with the reports that you may have as far as what are you doing as far as pollution, things like this. People who may be interested in investing in the organization, and managers of the firm. What they're doing is they're figuring out, okay, based on the financial statements that we have, what are the decisions that we need to make going forward? There's basically a 6-step procedure or process as far as the accounting cycle. It really starts with bookkeeping. In other words, capturing all of the information and putting that into journals and keeping track of all of the books. Now, when they talk about double entry bookkeeping, what they mean is you're really trying to make sure that everything balances, and I'll show you that here in just a bit. The process: you analyze all of the documents and things that you have and record them. Put them into a ledger, in other words, something that captures all of the information. And then what you do is you take a trial balance. In other words, you're kind of a test. Does everything balance? From there, you prepare your financial statements so that you can analyze what it is that's going on and make decisions. So the tools that you have is you have your ledger and your trial balance. You're constantly using technology, various accounting programs. For example, QuickBooks allows small businesses to keep track of their financials. Now, the financial statements. You primarily have 3 basic financial statements that are prepared from the accounting information. What you're trying to do is make sure that as everything balances. And when we say balances, we mean that our assets equal our liabilities and equity. This comes from the balance sheet. Now, the reason why it's called a balance sheet is because everything on the left side has to equal everything on the right side. It has to balance as far as the totals are concerned. The left side consists of assets. In other words, that's what you own. The right side consists of liabilities, what you owe, and the stuff that's left over, which is the equity. In other words, what is it that the owners have as far as value is concerned after you subtract your liabilities from your assets. Now, your assets are broken up into several sections. You have your current assets. These are things that can be converted to cash. In other words, you have your cash, and then you have the things that could be converted to cash in a short amount of time. In other words, your accounts receivable, what it is that others owe you. Your inventory, which can be sold. So these are things that can be converted into cash, your current assets. Then you have what's called fixed assets. In other words, your property, plant, and equipment. What is that worth today? And that gives you your total assets. Your liabilities are broken up into 2 sections. You have your current liabilities. In other words, those are the bills that you owe right now that you have not paid yet. Then you have your long-term debt. In other words, you take out a loan. Say you take out a $5,000 car loan for 3 years. Well, that's long-term debt. These are things that need to be paid within the first year, within this year. Then the stuff that's left over is what's called equity. In other words, people will invest in the company, and that's paid in capital, okay, the stock. Retained earnings are the profits that have been left over from previous years, so that you get your total equity. So your equity plus your liabilities should equal your total assets. The balance sheet is like taking a snapshot in time. In other words, on this date, these are the things that we owned and what we owed and what the equity was. So in the following slides, it talks about what are assets, things of value, liquidity, in other words, what can you convert to cash. You have your current assets, fixed assets, and then intangibles. Now, intangibles are things that are not necessarily something you can hold or something you can that has some sort of a cash value. The thing is, it is valuable to the organization. For example, any kind of patents that you might have, any kind of copyrights, those are intangibles and they're worth something because they are helping the business grow and operate. You have your liabilities, your accounts payable. In other words, those are the bills that you haven't paid yet. Notes payable and bonds payable. Those are basically more longer term. Then you have your equity and retained earnings. The income statement is basically like a movie camera. In other words, it's saying, okay, over this time frame, this is what happened in this business. What it's doing is it's saying, okay, over this time frame, it could be for a month, 3 months, a year, whatever it is. This is how much we had in sales. And cost of goods sold, that's the direct cost that it took to make that stuff that you just sold. So that would be like the materials that you used and the direct labor that went with it. And then you get your gross profit. From there, you start deducting your expenses. So in other words, it took a certain amount to sell those products, and you had to pay commissions and things like that. It's not directly involved in the making of the product, but it did cost you money to get that done. And so you take out your expenses and you get what's called your operating profit. Then what you do is you start taking away your interest. In other words, what kind of interest did you have to pay? Or did you have come in? And your taxes. Have to pay taxes. That gets you to your net income. So the income statement, it has that formula of revenue minus cost of goods gives you gross profit. Take out your expenses, gives you your net income before taxes. Take out your taxes, you get your net income. So revenue is your sales. Cost of goods are the stuff that it cost you to make those things that you just sold. Operating expenses are costs that were involved in running that business. And then depreciation. What that's saying is you have an asset that you purchased today. You use that asset. Tomorrow, it's not going to be worth as much. And so you have to depreciate or take away some of the value of that. On your financial statement, what you're putting in your assets are what things are worth today. In other words, less the depreciation. And that depreciation comes off as a part of the expenses. Then you have your third statement, which is your statement of cash flows, your cash flow statement. And what it does is it shows where did the cash come in and where did it go. So you have this stuff from operations, okay? You have your additions to cash. In other words, depreciation, it's considered, okay, we've added to the cash on that. what you subtracted. In other words, okay, what did we have to spend for our inventory? So there's your cash from operations. Then you have your cash flow from investing, in other words, purchasing equipment, and the cash flow from financing. In other words, what did we have to pay as far as the interest expense? So that gives you your final cash flow. Whole idea behind this is to really manage the cash that you have within a business. The thing to remember is cash is king. You cannot operate an organization without cash. You also have your ratio analysis. Now, what you're doing is you're identifying various ratios to see how the business is running, and it allows you to compare this business to other businesses. Are we running our business as efficiently and as effectively as our competition? The various ratio types might be profitability, solvency, in other words, can we pay our bills, liquidity, turnover, in other words, what's happening with our inventory, and then earnings. We're not going to get into what the actual ratios are, how to calculate it, or anything like that. Just understand that these ratios give you an idea as far as how well the business is running and can compare it to the competition. So you have your liquidity ratios, your leverage ratios, in other words, how much debt do you have? Profitability ratios, in other words, how effectively are we running that business as far as controlling costs? And activity ratios, in other words, what's happening with our inventory? Are we turning our inventory effectively? In other words, we're not making something and it's just sitting in the warehouse someplace. The various disciplines that go with accounting. You have your financial accounting. In other words, actually looking at the finances that are going on. What's happening with our income? What's happening with our expenses? What will happen is you'll put together an annual report. Now, if you want to see an annual report, you can go out and see Amazon's at this link right here. The things to watch for in those annual reports. What is management saying as far as the business is concerned? What kind of trends are actually going on? What did the business do over the past year? Look at the balance sheet. What are the things on the balance sheet? How has that changed over the past years? Look at your income statement. What's happened as far as the income and the expenses that you've had compared to previous years? What's happening with cash flows? And then what is the auditor's opinion? In other words, is the financial condition of the company good or could it be improved? Learning to read the annual report can be very beneficial. And the reason is because it's going to give you a lot of information. And if you learn how to analyze these financial statements, it's going to tell a story. The numbers will tell a story as far as what's actually happening with that business. In accounting, you have private and public accountants. A private accountant is somebody who works for an organization and they're doing the accounting. A public accountant is somebody who actually works for an accounting firm and they do the accounting for multiple companies. Then you have what's called CPAs, a certified public accountant. That is a certification that a person can earn who then will be able to sign off on annual reports, on tax returns, things like that. It shows that that person has a level of knowledge of accounting that's very beneficial. There's managerial accounting. In other words, you're pulling together the financial statements and the information that's necessary so that management can make decisions as far as what's happening with their production and their marketing and their budgets. You have auditing. In other words, going back and reviewing and evaluating the information and making sure everything is on the up and up. An independent audit is where you have an outside firm who comes into the organization and verifies the accuracy of all of the stuff that's there. Then you have tax accountants, people who focus in and specialize on tax. In other words, what are the taxes that have to be owed, which ones would not have to be paid? And then you have government and not-for-profit accounting. So these are some of the key points from the chapter. If you have questions, let me know.